Hey guys, what is up? George here from the Millionaire Project. So today we're going to talk about one of the easiest to use patterns in the stock market. As day traders, we have to be able to identify multiple patterns. So one point to start off at would be using the ABCD pattern. So as I said before, this is one of the easiest and most commonly used patterns in the stock market, and this is because it occurs very frequently, more so than other patterns. The reason this happens is because this pattern demonstrates key market fundamentals of how stocks move and how investors and other traders are thinking and causing these reactions for the stock to go up and down. So the ABCD pattern is fairly simple. It is a 4-step sequence. So it starts off with your point A. So your point A is where the stock will come up and hit an initial high price. In other words, your resistance point. You then will go to your point B, which is the stock will come back down and hit a low point at which you can call your support. You then look at point C, which is going to be your consolidation zone. And this consolidation zone is going to be between your point A and your point B. So in between your resistance line and your support line. So in other words, you are creating a trading range here with your point C. On your point D, you want the stock to push back up towards point A here, which is your resistance line, and you want it to break out from this point to move up higher in price so that you can collect your profit. So I know that looking at this here and just talking about it here is a bit confusing and it can sound a little bit intimidating. So let's go ahead and pull up an actual chart and show you how this works. All right, so let's get right to it here. So I pulled up a stock on my trading platform, DATS, and this was actually a stock that we traded in our group last week, and we used the same exact pattern. As you can see, I already drew everything out as we followed it. So the way that this works is you want to find a stock that has been going up in an uptrend in a bullish manner with some strong buying volume. So you can see this is clearly an uptrend here, and the stock made a significant high before pulling back. So at the top of this point here, we can call this our A, which is going to be our resistance line. So what you want to happen next is you want the stock to pull back, but what you want to make sure is that the selling volume is not as strong as the buying volume was on the way up, which you can see here, it clearly is not. This is a healthy pullback. So next, what you want to do is you want to find a point that the stock hits on the way down and bounces up from. This is now your point B, or in other words, your support line. So now that you have your point A, your resistance line, and your point B, your support line, you now have a trading range between these 2 points. As I just said, A is your resistance line and B is your support line. And this middle part here being your C. We would call this your consolidation. You want to make sure, and this is important, you want to make sure that the stock stays within a healthy consolidation range and does not dip below your support line here, because that is going to indicate the pattern has been broken. Thus, your investors and traders that have been looking at this pattern with you are no longer going to be looking at this. So next, what you want to do is you want to see the stock push back up towards this resistance point here with strong volume. So as you can see, the volume on this push here towards this resistance line is much stronger than the bullish volume we had here when we were consolidating. So this is going to cause your breakout, and this is your point D. So at this point here, now that the stock broke out of this resistance line, this automatically is going to become your new support line. And you can continue to adjust these support and resistance lines as the stock moves up and makes new highs until you collect your profit. It's a very simple pattern to use and very effective because it demonstrates common market fundamentals. You have a surge of buyers that take the stock up to a certain price, at which point many people will collect their profit. However, you do not want more people to collect their profit than the people that bought it on the way up. So you want the stock to stay above this breakout point here. Once it does that, you then have some consolidation until buyers pick back up in whatever stock it is that you are looking at or in the general market, causing the stock to break out and push up higher. This is a key market fundamental that is how most stocks work and how markets work. This is why this pattern is so successful and why it is one of the most commonly used patterns.